When it comes to the global economy, there's a term that's been buzzing around for quite some time now, the everything bubble. But what is it, and why is everyone talking about it? Simply put, the everything bubble refers to a phenomenon where multiple asset classes, from stocks to bonds to real estate, experience a period of rapid and unsustainable growth. It's an issue that's been brewing for years, and as we move into 2023, it's one that's starting to have a significant impact on the world as we know it. From the stock market to housing prices to job security, the everything bubble has the potential to upend our entire economic system. So, what exactly is the everything bubble, and what can we expect in the years to come? Let's dive in. The everything bubble didn't just appear out of nowhere. Its roots can be traced back to the global financial crisis of 2008, when central banks around the world implemented a strategy known as quantitative easing to stimulate the economy. This flooded the market with cheap money and artificially low interest rates, creating a culture of reckless investment and speculation. As a result, tech stocks experienced an unprecedented boom, with venture capitalists pouring billions into unproven startups. But now, as inflation rates soar and central banks tighten their policies, the everything bubble is starting to deflate, leaving many investors and businesses wondering what the future holds. The evidence of the everything bubble bursting is evident in the sharp sell-offs and declines across various asset classes. Housing markets, which have been experiencing an unprecedented surge in prices for the past few years, are beginning to show signs of cooling off. Stocks and bonds have also been impacted by the bursting of the everything bubble. The S&P 500, a benchmark index that tracks the performance of 500 large-cap US stocks, has experienced several significant sell-offs in recent months. The bond market, which has been buoyed by low interest rates since the crisis, is also showing signs of weakness. Inflation concerns have led to an increase in yields, causing bond prices to fall. Even cryptocurrencies, which have been on a meteoric rise in recent years, have experienced sharp declines. Bitcoin, the largest cryptocurrency by market capitalization, fell by over 50% from its all-time high in April 2021. While it has since recovered some of its losses, it remains volatile and subject to regulatory uncertainty. The impact of the bursting everything bubble on various industries and markets could be far-reaching, potentially leading to widespread job losses and economic disruption. For instance, a decline in the housing market could lead to a slowdown in the construction industry, leading to job losses. Similarly, a decline in the stock market could impact consumer confidence and spending, leading to lower economic growth. As the world becomes increasingly divided into two techno-feudal fiefdoms, one US dollar denominated and one Chinese yuan denominated, the role of tech giants in the everything bubble becomes increasingly significant. These tech giants, along with other major corporations, have contributed to the formation of a bubble in various asset classes, including housing, stocks, bonds, and even cryptocurrencies. This has led to classic echo bubbles, where investors refuse to give up on ideas that recently made them a lot of money and keep piling back in until serial disappointments kill the faith. The rise of techno-feudalism, with a small number of powerful corporations and individuals controlling vast amounts of wealth and power, has had a significant impact on society. Class struggles within each techno-feudal fiefdom, as well as between them, generate destructive forces that threaten our species' survival, from a new Cold War to economic disruption and job losses. The bursting of the everything bubble is closely tied to the rise of techno-feudalism. The everything bubble is a phenomenon that refers to the overall high valuations of various asset classes, including stocks, real estate, and bonds. There are several predictions for the future of this bubble. Dan Ferris predicts that the US markets could slip into a cataclysmic dead zone, an extended period where securities could trade sideways or suffer a gradual decline for years or even decades, and some markets that have drifted into one have never fully recovered. If the everything bubble bursts, there could be several potential implications for the economy and society. The slowing economy is likely to bring the yearly inflation rate down to roughly 3.5% to 4.0% by the end of 2023, which will still be higher than the Federal Reserve's target of 2.0% to 2.5%. Moreover, a burst in the housing market bubble could lead to defaults and foreclosures, ultimately increasing the market supply of homes. It is important to note that while the everything bubble may seem daunting, it is not necessarily a foregone conclusion that it will burst. However, it is going to be an important time for policymakers, and the battle to avoid a potential economic crisis is likely to burn on for the next little while.